Hey everybody, it's Chris with Life 180, and welcome back. This is my second live that I've done today. I think I've probably done maybe a handful of lives in my entire time here on YouTube, and two in one day. And the reason is because I kind of dedicated, I thought about it last night. I was going through my YouTube channel. If you watch my videos and engage with me, you know that I do my best to respond to every single comment that I possibly can. I got inundated with comments over the weekend, good, bad, some in between. But I wanted to, let me put it this way. There were some comments on there that to me were just, they warranted more than just a text response, because I feel like one of the things that I want to make sure to never be is defensive when I'm responding to people on there. Hey KM, thank you, I appreciate that. One of the things that I always want to make sure is to be as responsive as possible. I don't ever want to be defensive. The whole objective to me creating the content that I create is to give as much value as possible. I want this to be purely about education. I want people to understand what they're getting involved with. I want people to understand like all the moving parts behind the decisions that they're going to make, whether they choose an IUL, whether they choose a whole life policy, whether they choose to not go with either of the above, and they just want to do something else and get, maybe buy real estate and do, or just stay in their business or whatever it is. At the end of the day, to me, it's all about education. And so for this video, I want to do what I was planning on doing earlier. I ended up having a couple comments in the chat box here that ended up dominating the conversation for my live video earlier. If you haven't seen that, I would suggest go back and watch it because I think it was pretty good. But for this, I'm going to go through and I'm going to attack and challenge and address all of the comments and questions that I had in my feed. Now, just so you know, when I do this, I'm not going to be able to look at my chat string. So if you engage and you chat with me, I'm not going to be able to watch the comments as they're coming through. So I'll try to switch back and forth as much as I possibly can here. But here we go. Let's get into this. Let me just get myself up on the screen there. All right, so here we go. I'm gonna just get right into this and start asking for questions or looking for the answers there. So Jose Guerrero says, hey Chris, looking into whole life, do you have any more introductory videos as well as what whole life is, what it does as part of the strategies one could pursue? Thanks. Okay, so on this, I did respond to Jose directly. I actually sent him an email. But what I would say as far as that goes, that's my live feed. What I would say on that end is I'm going to go to YouTube, and what I will do is I'm going to put that, hey, there I am, right there. Whole life insurance 2021. Let's see what that pulls up. See if it pulls up one of my videos here. Okay, so this is actually, yeah, this is one of the videos. So if you go here, I'm gonna go here and I'm gonna copy and paste it into the link there. Oh my goodness, this guy's crazy. You probably can't hear that because I have it minimized. But what I'm gonna do is I'm gonna go in here and I am going to pop this in the chat so y'all can get access to that video. That is the video on whole life structure. There's also another video that I did. If you haven't seen it yet, what I would suggest going on is looking at the video I did on how to use whole life insurance as an investment. One of the things that you understand if you follow me, whole life insurance is not meant to be an investment. It's meant to be a storage vehicle, a banking alternative. And when you use it appropriately, you can leverage it to buy investments. And when you utilize whole life insurance as part of a system, it makes every investment that you make better. That's why we call it the and asset, right? And so when you do that, I actually have a video on how to use whole life insurance as an investment. And when you watch that, I use one real estate property that you buy, and it shows you how to actually create $300,000 and more net worth by just flowing your money through a whole life insurance policy through that one video, right? Or through that one property. You could actually stack that and do it more and more and more, and it gets better and better and better. And so you can kind of go from there. But that's where I would start with for that. Now, let's see if we can get into anything a little bit more juicy. All right, so Trey Farrow. Here, I am here. Oh yeah, see, I did respond to some of these on chat, but I want to address them. So why make a video bashing someone? So this is about the Doug Andrews video that I made, Doug Andrew video that I made. Why make a video bashing someone if you feel your way is better? If your way is so much better, then why not just promote your way instead of going after somebody else? And why this video after so long? He's been making videos for years, and you're now just making this video. I sense animosity. Well, there's some of this, there's a lot of layers to this. So first of all, there's no animosity towards him for his own production, so to speak. If there's any animosity, it's because I defend the life insurance industry, right? And there's a lot of things going on in the life insurance industry. If you're not in the industry, you probably are not aware of all the regulations coming down. What's happening is a lot of the people that are out there selling index universal life improperly, like Doug Andrew, and misrepresenting what it can do, what's happening is the life insurance industry is smashing down, and the financial regulatory bodies are smashing down and changing the rules, changing the requirements that are required for agents to be able to, like, what they can and can't talk about with people. So it really, because of people like Doug Andrew, it really restricts people's ability in the life insurance industry to go out there and serve in a powerful way, because they're being limited based on the fact that people like Doug Andrew go out there and they screw it up for everybody else. Now, the other reason that I made this video is because honestly, I just found out about Doug. Like, Doug's videos, I mean, if you look at his followers, I mean, I've been, I guess, subscribed to his channel for maybe a year or so. And the growth of his channel has been pretty big lately, probably because he has a new book coming out. But the problem that I have with this book is when I started researching into Doug, and I didn't know much about Doug until recently, and when I started looking into him and realizing, like, he's got all these lawsuits, his son lost his equities license, his company's gotten in all this trouble. A lot of people are coming at me about Doug being like, oh, like, anybody can sue anybody for anything. You don't get involved in a class action lawsuit by accident. You can't, nobody could just sue anybody for anything when it comes to a class action lawsuit. You have to get an attorney to be willing to take up a case, and for that there has to be a big body of evidence, there has to be numerosity, there has to be tons of people willing to step forward. And it's not an accident, it's not a coincidence. There was one insurance company named with one agency, and it was Doug Andrews agency and an insurance company that was named on this case. And listen, it's just ugly. Like, I have a problem with him in general. Like, you know, it is what it is. Listen, I just got done actually having lunch with Curtis Ray, and you know what? I actually, even though, like, I'm still trying to feel through it a little bit, the bottom line is, like, Curtis Ray, I can tell you, I will honestly say, even if I don't agree with him 100%, I do think he's a good guy. I had lunch with him. I think he's a good guy. And I can't say the same about Doug Andrew. And so I'm going to be doing more research. Curtis and I are going to be talking. It's another conversation. I don't want to get too deep in that right now. Literally just got done having lunch with him. And the bottom line for me is when you work with a financial advisor, who you work with and their mindset and their heart and how they're trying to serve people is more important than anything. You got to make sure their head is in the right place, and Doug Andrews' head is just not in the right place. So let me go back here and see if I have any comments or anything, and we will go from there. Nothing yet. So let's keep going on these comments here, and we'll see what I can find. What am I doing? All right, sorry, I got to get used to hitting these buttons here. All right. Would enjoy learning where that 1 month for every $10,000 of income heuristic comes from. All right, so I was talking about the fact that you should save 2 years of income inside of a whole life insurance policy. You should have it as a safety account. Your savings and safety account, emergency account, should be 2 years of your income, not 6 months like Dave Ramsey says or Susie Orman says, but 2 years. And I know that's 400% more money. Seems like a crazy amount, and it seems hard and unattainable. That's probably why they don't tell you to do it, because you're probably not going to try to do it if you don't feel you can succeed in it in trying to achieve that kind of benchmark. But the bottom line is, the U.S. Department of Labor, that heuristic comes right from the U.S. Department of Labor. One of my other clients, if you follow my stuff, you know that I'm a business development guy. I run a business development agency. I help companies build their businesses. If you go to executivejobsearch.net, that was a client that I helped build their business online. And in that process, We had all sorts of research done with the US Department of Labor. They're an executive job search firm. And that was one of the statistics that we found, that we came up with, that is directly from the US Department of Labor. So that's where that comes from. Thank you for the compliment. Let's see here. Love the consistency. Can you do a video explaining the common mistakes agents make when designing a whole life policy for infinite banking? Here's the problem that I have with infinite banking. I'll go from here. Problem that I have with infinite banking is you get all these people that are at the Nash Institute that they're certified from it. Some people are not certified through the Nash Institute, but my overall general problem with infinite banking is people feel like there's just this one size fits all answer, right? And typically it's like, whether you believe in a 60-40 split or a 70-30 split as far as the base premium to paid up additions inside of a whole life insurance policy, or whether you believe in a 90-10 breakdown of a policy. It really, what my challenge is most IBC practitioners kind of get on the one track that they believe, and they think that this is the only way to do it. And here's what I'll tell you, is that there's positives and negatives to each strategy. And I think the biggest mistake that's made when it comes to designing an IBC policy is, instead of starting with what the objectives are of the individual, starting with the objectives of, I believe this is true, I believe this is how it needs to be done, and this is what an IBC policy needs to look like. IBC is just a concept. It has nothing to do with specific, in my opinion, has nothing to do with specific policy design. I know there are a lot of people that are going to argue with me on that. I think the philosophy, IBC, remember, is just a marketing term. It's a marketing concept, right? No different than anything else. That's why we use the and asset and we work with BetterWealth, because listen, I think that's a better conversation than infinite banking. Personally, that's why we leverage that concept, and I think it's a much more pure concept. I think the other mistake that infinite banking people make is they try to tell people that you can earn interest by paying yourself back interest, and that's not how it works. The math just doesn't work out. And so I think IBC is about 90% there, maybe 95, but that last 5%, there's a little bit of math that's off, and it's sad to me, because the concept on its own is so great that, you know, like, to have to kind of misrepresent some of the math just to make it look too good to be true, so to speak. And it looks too good to be true a lot of times because it doesn't really work like that. And a confused mind always says no, and I know that. And so one of the things that when I'm working with people, with some of my clients on the business development side, and I'm trying to coach them to leverage, you know, financial structure to be able to enhance their business growth, they look at the infinite banking. I could give them the Nelson Nash infinite banking book, and they look through the graphs and they're like, this just doesn't make sense. I'm like, yeah, because it's not 100% accurate in that way. And so you break it down and you're like, well, this is great anyway. Why even make it something that it's not? And you know, the answer is, you know, whatever. Like, you gotta find somebody that you can trust. It goes back to the Doug Andrew thing. Hey, Jose, lunch was awesome. I'll probably be doing more content on that. Actually, I got to tell you, lunch, Jose, was great because my conversation with Curtis was actually really good. I think he's a good guy. He's got his head in the right place. We serve a completely different person. I told him I still have some challenges with what he does, because I don't personally, I'm not sold on it being completely optimal yet. However, I can see where he's coming from his heart, at least. I still don't see the math side of it personally. He gave me a copy of his book. I'm gonna go through his book. I've got his cell phone number. I'm gonna stay in contact with him. So I don't want to say anything disparaging. I don't, you know, like I'm gonna go from there. We're gonna see how it goes. And that's where I'm gonna leave it. But I will say this: his heart is great. The part that he said to me that I really it made sense to me was the fact that he's like, listen, I'm just trying to serve people who are putting money into a 401k and are putting money into an IRA, and I want to give them an alternative. He has a mission of serving 10 million people, right? And so with what I do, 10 million people couldn't do the strategy that I do, because I'm going out and dealing with a higher level, people that have much higher objectives. He just wants to help people that want to save anywhere from $300 to $700 a month to meet a goal. I don't think it's going to end up being as good as he says it's going to be, right? Because there are too many variables involved. However, what he's doing, I will say, is better than just blindly putting money into a 401k or an IRA. And I told him that much right now. And that's all I'm going to say about it right now, because I'm working through it, and we'll see how it goes. I mean, ultimately, he was a good guy. We're going to stay in contact, and maybe we'll end up doing a video together here at some point in time. He's definitely a guy. He cares, and he's a smart guy. He knows his stuff. At least, and he's a great marketer. So, I mean, if there's a way that we can find a happy medium to understand what his avatar is, so to speak, like who his product is best for, and understanding what we do and how I coach people and how it's, what our strategies, who they are best for, I think it might be a good match. So we'll go from there. Green Legend, I'm a new 18-year-old financial advisor. Any advice? I'd love to help families more effectively if there is a way. So yeah, I mean, my advice, thanks man, thanks Jose. So Green Legend, my advice to you would be literally just invest in yourself, build your own confidence. One of the things when I was working with Caleb Williams out of the beginning, like, he's a unique individual because he took a ton of time and a ton of effort and energy and money, invested it into himself, and built his own expertise. I'm a big believer money follows value. So you need to make sure that you are as competent as possible. It's the confidence loop, right? So the more competent you become, the more confidence you gain, the higher level conversation you can have. The more confidence you gain, the more confident you become, and it just becomes this infinity loop where it just competence breeds confidence, and that will get better and better and better. I would say make sure you plug into a system too. Make sure you work with people who are in alignment with what you want to create. Like I see too many people want to get into the industry, and then they join a WFG or a PHP, and then they get in there and they're like, whoa, I joined this because I really wanted to help people. And then they realize like that model is all about like just recruiting people. And there's some people that do it better than others with serving people inside of those organizations, but for the most part, that's not the case. So you want to make sure you go out, you find people who kind of have achieved what you want to achieve, that their philosophies and strategies align with what you're looking to accomplish and what your mission is, and then try to learn from them. The best way to get somewhere is to find somebody who's done what you want to do and emulate what they're doing until you achieve the result that they are after, or that you are after, right? And that is that. So let me see here. I'm gonna pop back over here and we'll get to another question in here. So, all right, so there's some racy comments in here that get really fun. Let's see here. 429 Moss. Okay, so the admin fees and insurance costs are not significant enough during a 0 year, as opposed to losing 20% of your accumulated value due to the down market. So of course, I'm highlighting it here so you can see. So of course, there's going to be more added risk wherever there's more growth potential, and it's nothing new by looking at all of your videos. You're just generalizing all policies based on what has happened in the past with poorly structured UL policies that were illustrated back in the 80s, 90s at a 10 or 15% rate of return. So this guy, I'm gonna just flip back here. This guy doesn't even know what he's talking about. So first and foremost, my assumptions were not going back to 80s and 90s policies, and they weren't UL policies. I'm talking about policies that I personally wrote. Like, so I'm just gonna put myself on the hook on this one. That I personally wrote that were option B, increasing death benefit, maximum funded up to the MEC limit. And when I sold them, they were sold and the policy had a 14.5% cap rate, right? I illustrated these policies at about 7%, okay? The policy in the greatest bull market decade in the history of our country didn't perform to the 7% illustrated rate. Why? Because the cap rate kept going down and insurance costs went up, right? So when illustrations, the illustrated rate that I ran it at, and then you look at the cap rates and you look at the actual performance in the policy, when it doesn't perform in the best decade that we've had, it's kind of disgusting. To me, I just don't understand. That's one of the reasons, it's the main reason, honestly, that I don't like Index Universal Life, is because it's a chassis that The variables, there are too many variables outside of your control. I'm a big believer, if you want to accomplish anything significant in life, you have to take risk. There's no way around it. But I'm a big believer also that I want to take risk in things that I can control. When you put, it's one of the big reasons I don't like 401ks or IRAs is like I'm putting my money somewhere and I'd be tying that money up and I'd be paying fees and I wouldn't be able to access that money and all these things until I turn 59 and a half. The good news about an IUL, the only thing I will say positive about an IUL is it's better than putting money in a 401k or an IRA. If it's option B, if it's max funded, and you go from there. Because, you know, I think the fees in an IUL, and if you have the right assumption rates and you do it right, you're not gonna get hurt and it will be better than your 401k, but it's still not optimal. That's another conversation I had with Curtis, is like, to me, I don't have the ability to stop just at just helping people get out of 401ks. If I know there's an optimal way to do it, I need to help get people to that optimal place. And I feel like that's where he stopped and is just, you know, wanting to stay there. But what I will say is, you know, IULs, if you do it that way, if you run it as a 5% assumption on the illustration rate and you're comfortable with the numbers and the results out of that 5% illustration rate, I think you're gonna be fine. It'll perform actually probably very similarly to a whole life policy, probably a little worse than a whole life policy, honestly. But that's that. Like, you know, so that's what I would say. Let me get this, like, make sure I answer this question properly. Oh yeah, but he was saying that I'm basing it on old UL policies. No, I'm basing it on policies that were written after 2010 that were maximum design with a top 4 company in the IUL space. So it wasn't a UL chassis, it was an IUL chassis. So that is what it is, like, just whatever. Looking. Oh yeah, so here we go. Let me do this. All right, so whole life is too expensive. Let's see here, it's this one right here. Whole life is too expensive and fixed, not as flexible as IUL. A national life insurance policy has free, full living benefits, but none others. I will say National Life is a company that I used to work with, so I'm very fully aware of National Life. Actually, the policy I was just talking about being underperforming was a National Life policy. That said, National Life, one of their strengths is they do have great living benefits. That's one of their highlights, which is fantastic. And so that is with everything. But to say they have free, believe me, the cost, it may not be in the policy as that, but the other costs of insurance and everything, there's nothing in the insurance space that is free. Stop bashing other competitors as it doesn't look good on you, but start disliking you. Well, you can dislike me if you want, that's fine. I'm not here to make friends. I'm here to give value and educate people. And the people that are threatened because you're worried I'm going to expose you and give people education that's not going to align with your paradigm, that's your problem, not mine. Just as if people don't like me, they don't have to subscribe, they don't have to follow me. That's their prerogative, and I'm not here to make friends from that perspective. I could not care less. So everyone is entitled to sue anyone civilly. Oh yeah, so now she's referring to the Doug Andrew. How would you feel if you were in the shoes of Doug Andrew? Well, first of all, I'll never be in the shoes of Doug Andrew because I'm never gonna, go scam 66,000 people. I'm never gonna sell a Ponzi scheme as a method or vehicle for people to fund their whole life insurance policy or IUL if I were to be in I'd never sell a Ponzi scheme or get in alignment with that kind of contract anyway. How would I feel if I were Doug Andrew? I'd feel fortunate that I'm not in jail and all they did was take my license. That's how I would feel. And I would probably just shut my mouth and get off of YouTube and stop trying to sell and scam people. That's how I would feel, honestly, if you want the truth. So no, I don't feel bad about that at all. Sorry, I just realized I didn't have myself on the screen. That would have been nice. But congratulations, Hannah Kirkpatrick. That's a nice one. So if everybody doesn't know, my wife just won the Mrs. American pageant, so that makes me Mr. American. That's a funny little side note. So financial efficiency sounds a lot better than a budget. Yeah, it does. So check this out. So I did a video on the fact that the biggest mistake people make in their personal finance is when they have under $100,000, people are too focused on chasing a return. The same thing goes with an IUL. The idea of trying to get a bigger return inside of your policy, it's a zero-sum game. It's no different than looking at trying to chase returns in the market. What you need to be focused on is financial efficiency, period, right? So because most people don't realize they're bleeding money, right? I could help you find $500 a month in your personal finances right now. And if you have $50,000 saved for retirement right now, and that's all, maybe you're 30 something, or maybe you're older and you just never saved any money, I don't know. But if you can find $500 a month and increase the financial efficiency in your life by $500 a month, that's the equivalent of earning a 12% rate of return on your 50 grand. That's, so it's the biggest no-brainer is to focus on efficiency early, build good habits, and then you're going to be set up to take advantage of opportunity. Oh, there's a Jose Guerrero. Thank you for the comment. Can I learn from you? Yeah, go ahead and set up an appointment. I'm happy to talk to anybody for a short period of time. I'll give anybody, if you're driven, I'm happy to talk to you for 15 minutes and see how I can help, at least point you in the right direction. Okay, so D-Moon, is that a loan interest rate fixed or contract time? I don't know. I can't answer that because I'm not going to go into the video right now and do it, but it looks like I already responded to him, so that's good. Possible to get front-loaded whole life insurance policies properly structured with no load commissions? Well, I mean, like if you front-load a commission, here's the biggest difference. What I'll say with a front-load, whether you do IUL or a whole life, IUL, you're always going to lose liquidity of the money out of the gate. It just is what it is. You're going to have low liquidity in year one with your universal life policy. I was just actually talking to Curtis Ray about this with the MPI. He's like, hey, listen, mine is always a long-term play. We have a different avatar. We have a different person we're looking to serve. I work with a lot of real estate investors, a lot of people who have an affinity to get money inside of their business quickly. They need the liquidity for their business, and they need they need the liquidity to maybe buy a real estate property, right? And so what happens is in an IUL, you don't have that liquidity year one. It's always tied up in surrender charges. And with a whole life policy, you can set it up so you have up to 90% liquidity. It depends on how it's structured. I'm not saying that's the way you should do it because there's always a give and take. But once again, it just comes down to what are your objectives, what are your needs, and you can go from there. So let me see. I just want to check back here and see if I have any. Yeah, man. So here, I'll type in calendly.com. Yeah, so that's the link. If you want to go in and set up a call, that's the link. Anybody can go on that link. And guaranteed income, index universal life. Hey, Robert. So GIULs are great from an estate planning perspective. I've used GIULs actually quite a bit back in the day. I used to use North American. They had a great GIUL product. I'm not sure what their current offering is, but the bottom line is this: is that GIULs are fantastic if it's an estate planning situation. They're basically using a GUL concept, but they're putting it on an IUL chassis, so there's a little more upside than there would be with a typical GUL, but you actually have the guaranteed death benefit if you fund it properly. And so, but I would say you don't want to use a GIUL for income planning purposes or for any kind of cash flow or anything like that, because there's going to be too many expenses inside of that for the guaranteed side of it, right? Guarantees are going to be higher, cash accumulation is going to be a little lower, the guarantees are going to be better. It's kind of a hybrid, and if you're looking from an estate transition or preservation or legacy play, GIULs are actually very affordable. I'd go with a GIUL over a whole life insurance policy from that perspective 100% of the time, typically. Like maybe not 100, but definitely over 90% of the time. So that's that. So, okay, answered that question. Let's get on to the next question here. Let me get back here. Does everybody like this, by the way, like going through this? Because I don't want to do this if nobody enjoys it. Because I'm just trying to be as transparent as possible, because I'm even showing you guys all the comments that sometimes I hide because I don't like it when people are swearing on my channel and doing all that stuff. Let me see this guy. Okay, so Victor Cuevas, he and I got back and forth quite a bit. We ended up battling a significant amount. So this is going to take me a minute to read this. So you talk about all the insurance fees and administrative costs coming out of an IUL that are hurting the opportunity to grow. Why don't you mention the cost of a whole life insurance policy? There are many costs as well. The thing with the whole life policy is that you can't see what the costs are. Okay, so this is, okay, so I'm gonna stop there and I'll continue after. I wanna answer this part first. I'm gonna highlight that so I know where I left off. So here's the deal. Yeah, exactly. Well, thank you, Jose. That's what I'm trying to do. So here's the deal with what he just said about the cost, is that whole life insurance is not as transparent with the costs. Well, guess what? I don't really care like what the costs are. I care about the actual performance of the policy, the money in, money out of the policy. The problem that I have with IUL is the cost. They try to make it seem transparent because they're like, oh, you're gonna have the admin costs here, you're gonna have the insurance costs here, and here's the cap rates and all these things. And they say, ooh, we're gonna illustrate it on this. But they don't allow you to illustrate by adjusting any of the variables that they have the ability to like change on any given year, right? So to me, that's not transparent because they make it seem transparent, and that what that is just more deceptive. Whereas in a whole life policy, they don't break down where all the charges are, what are the insurance fees, what are the admin costs. It's all kind of lumped in together. So some people don't like that, but to me, I don't care. I care about, like, one of the ways that I make decisions in life, and I was taught a long time ago by a mentor, is you think about three things. There's three questions you ask yourself. What's the upside? 1. What's the downside? 2. And 3, can I live with the downside? So I always look at the opportunity on the downside of things and I say, okay, worst case scenario, can I live with that? Now, on a whole life policy, for me, the answer is 100% always yes. Like, because I'm gonna beat inflation, I'm gonna be better off, I'm gonna have liquidity, use and control of my money. And so the downside, worst case scenario is, you know, if I have to lean on the 4% guarantees, I'm good to go. Like, that was one of the reasons I pivoted away from IULs is because I saw too many people getting hurt. And one of my biggest beliefs is, like, it's not the things that we expect that happen that kill us in life, that hurt us in life. It's the things that are unexpected that take us by surprise. So expectation management is everything. So that's what I'm saying. If you're gonna run an IUL, run it at 5%. If you're comfortable with those numbers, to me, that's a little more realistic. Running it at 6.5%, 6.4%, to me personally is just not realistic. It's not realistic over the long-term rate when you look at the fact that low interest rate pressures are putting pressure and stresses on the general accounts of life insurance companies. And so they're gonna have to reduce cap rates, and that 6.4% is gonna drop down. I think the 5% rate is just more realistic with where we are in the economy, with the stresses and the financial stability of these companies. Because remember, all these life insurance companies that sell IULs also have products that they've sold that they have guarantees that they have to back up. If the guarantees in an IUL are really low, like a 3% cap rate, which is what they are typically, and a 0% floor, well, then that's not much of a guarantee at all. They can drop the cap rate from 10 to 3 to pick up that guarantee just to fund and protect all the other customers that have actually bought guaranteed products with them. That is where their fiduciary responsibility is. If you want to look at it like that, it's like they have to take care of their guarantees first and foremost. The IULs are the easiest place a lot of times to recapture that money, if that makes sense. So, all right, I got more questions here on the channel here from you guys. Oh, thank you. I try to take the questions as much as possible. What's the net return on whole life? Do you carry our arbitrage with whole life? Do you carry out arbitrage with whole life? That's what he corrected with. So yeah, you can. So if you use a non-direct recognition whole life policy, you can have arbitrage. You can take part in the arbitrage. That is one thing. But the other thing that is beneficial, it takes a little extra work, but it's really, really worth it. And it's all done on a case-by-case basis, but you can get a relationship with a bank. And because whole life insurance, if the policy, this isn't always, you can't do it right out of the gate. So you have to understand that this is part of a system. But once the policy is a year old at minimum, and it's even easier once a policy is 2 years old, you can go to a bank because you've gotten through a lot of the fees, you've shown that you're committed to this policy, and there's enough cash in it typically to warrant the bank doing this. But you can go to a bank, like I had a client the other day, and when I say client the other day, like a client that I had 8 years ago that I still talk to, that I engage with, and I help him with business stuff. But he took a loan against his policy, but he didn't take a loan against it from the insurance company because the loan rate with the insurance company was over 5%. Granted, it was non-direct recognition, and he could have got a 6.5% dividend rate or something like that. That is the current dividend rate. but he was able to go out and talk to his local credit union and say, hey, can you use this policy as collateral? And they said, sure. It's a cash-backed loan essentially to a bank. They give him a 1.8% interest rate on it. Like, so that is awesome arbitrage right there, because now he's using the bank as or the life insurance contract as collateral to get a guaranteed 1.8% loan. Now the only downside to that is that it is a structured loan payment, right? So if he needed to and he couldn't afford to pay that payment 1 month, he would have to take a loan against his policy to make the premium payment, or or make the loan payment for that collateralization. But that is a huge arrow in the quiver. If you've got a halfway mature policy, you can use it as collateralization. They will not do that with IULs. Banks will not do that with IULs, and that should tell you a lot, because the guarantees in an IUL just don't suffice the requirements that a bank needs to be able to use it as collateral. So that's something to take into consideration. Yeah, it's an awesome interest rate, Jose, because of the fact that it's a guaranteed account earning 4%. They know that, even if your real rate of return, your internal rate of return in the policy after all fees at the beginning is probably new money in, and money coming out of it on year 2 is probably in the 2 to 3% range, but they know you have the cash there to back it up. So it's assets. And that's about financial management, structure, and relationships. Like, that's the thing people don't realize. This isn't just math, it's about relationships and strategy. And so if I had an IUL with 200,000 in it, and I had a whole life policy with 200,000 in it, and I went to a bank and I said, hey, I want to collateralize and get a cheap money loan for anything, whether it's a business or whether it's a real estate property or whatever, they would use the whole life policy, but they're not going to allow you to use the IUL as collateral because the guarantees are not where they need it to be, and the fees are not guaranteed, all that stuff. So something to consider. So what are guaranteed insurance contracts? What are guaranteed insurance contracts? Is that a different product or a marketing name for IBC Whole Life? Okay, what are I gotta just read that out right, make sure it makes sense to me. So guaranteed insurance contracts, it's just, so the guarantees are just part of an insurance contract, right? So if you went with an index universal life, there's always gonna be an illustrated rate, and then there's gonna be a guaranteed rate, and then typically they have a couple columns in between that will be some hybrid in between areas, right? So when you look at that, the guaranteed column is just the guarantees on it. That's kind of like the worst case scenario, right? And for IULs, it's never pretty. Now, in full defense of IULs, I don't think we're ever going to get to a situation where the guaranteed column is going to completely come into play. Because it does take into account that it's going to be the highest fees, the lowest cap rates, the worst return in the markets, like the S&P 500, for instance, if you were using that index, is going to be at 0 for a prolonged period of time. That's never going to happen. I mean, if it does, we got a lot more to worry about than the performance of your IUL. However, somewhere in between, like when these Yahoos out there that are illustrating at 7% right now, I think a lot of illustration software will actually allow you to illustrate 7 to 7.5%. Most of the people that I know are doing 6.4 to 6.6%. I think 5% is kind of the number, right? That you can look at and be confident with, but once again, it's not guaranteed. In a whole life policy, you're guaranteed a 4% internal return in your policy. Now that's not an internal rate of return, that's just the growth on your cash value after expenses. Oh, now he's making an adjustment on I'll just finish this thought. So that is, the internal rate of return is, there's different ways to look at it. I mean, one of the challenges anytime you put money into an insurance contract at the beginning is it's going to have a worse return at the beginning because there's a cost to buy into the system essentially, and it is insurance, so there's going to be a fee at the beginning. The one question that I get from people all the time is like, can I only pay this for 10 years? Can I only do this for 10 years? My response to them always is, sure, you can, but I'm telling you, once you get to 10 years, you're not going to want to stop. Like, once you do this for 10 years, you've already paid your dues to be in the system, to take advantage and take part in this. So after doing this for 10 years, there's not going to be another financial vehicle in the world that's going to be able to touch what you're doing in a whole life policy. Like, you're going to want to put every dollar into this thing that you can. You're only going to wish that you were able to put more in, but you're going to be capped because of everything. So, okay. Robert Clark, have you heard of the Kaizen strategy? If so, what are your thoughts? I honestly have never heard of the Kaizen strategy. I will have to look it up. I will make sure to check it out. Sorry, I meant investment grade insurance contracts. What are they? And what are the pros and cons? So I think investment grade insurance contracts is another marketing concept. I think different people talk about them differently. I will have to, if you have somebody that you know is talking about them, let me know, and I can kind of I'll do a little research, and I'll break it down, and I'll evaluate it, and I'll compare it to what I know. What I know of insurance of investment grade contracts, I've heard people talk about them in different ways. You know, investment grade insurance is talking about people where you have upside return, and they like to talk about IULs. Other people talking about guarantees, but that it's not investment grade to me at that level. Like I would have to like see who you're talking, because I've never seen an insurance company market an investment grade insurance contract. That's always a marketing ploy by an independent agent, right? And so it would really depend. I've seen all different angles on that conversation, and so I don't even want to touch that. What I would say though, in the terms of why I believe in this, just to reiterate what I was saying earlier, is the fact that, once again, it just comes down to collateral. If a bank is willing to take a whole life policy as collateral, and I've done it both ways. I've tried to have clients go down to banks and utilize their whole life policy as collateral with credit unions, local community banks, stuff of that nature, and they've had success. With IULs, they've never had success. So I would encourage anybody with an IUL, you think you can go do it, go try it, prove me wrong. You're not gonna prove me wrong. I've tried it 50 times, it's never worked. With a whole life policy, if you go into a local credit union, you have a relationship with a banker, and your policy is mature enough and you have enough collateral capacity, if you have enough cash in the policy, you're going to be able to leverage it. It's just a matter of going in, and you're going to be amazed at how low the interest rate will be. If you're willing to put a little work into it on that capacity, it's the biggest no-brainer in the world, because why would you ever borrow against your policy using the insurance company's money when you can use that as leverage to go to a bank and use it as backing, as a guarantee behind the loan? And when you do that, they're going to give you a super good interest rate. I mean, I'm talking, like I said, last week I had a guy get a 1.8% interest rate doing that. But I don't have relationships with banks that can pull that off for people. It's a function of you having a relationship, because it's very local bank driven. The big banks don't like to do it. The little banks love to do it because they're always looking for guaranteed free money like that. And to them, it's a great spot to go from. So, all right. So that is the end of those questions. Let me go in here and I will hop back in. Hop back into this. Here we go. Here I am. I got to keep going on this question here now. You can't get the report in the illustration itemized costs. Okay, I already answered that. That is, however, part of an IUL illustration. Yes, they tell you all the costs in the IUL illustration. Good for them. And they don't tell you what they're going to change the cost to. It's kind of garbage. Once again, they give the illusion of transparency, but then they don't allow you to illustrate it with all the moving parts. If they could do that, that would be amazing. So you could actually maybe have a lever that showed, okay, what does the policy look like if the cap rate gets dropped in year 5? What would the policy look like if insurance charges went up or admin charges went up, or if the cap rate gets reduced by 0.5% every 2 years, right? Like that to me would be transparency in an IUL. If they're gonna have all those pieces that move, make illustration software that can accommodate it, but they don't want to do that, because if they were to allow you to see what they could do to your policy and how they could just take the money out of your policy, you wouldn't want to buy the product, right? Like that's just it. So they don't want to do that. And plus it's their out. It's like they say, they try to pitch it as this retirement income, tax-free haven, for retirement income inside of the policies. But then when people have problems with them, they go, well, you bought an insurance product. What do you want? Like it just is what it is. So this way I can easily compare IUL policies. Okay, blah, 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 blah. You compare whole life policies very cleanly. Like IUL policies, once again, he's basically saying it's great because you can compare IUL policies based on costs and all that stuff. No, you can't, because of what I just talked about, all the moving parts. Every company's a little different, and you don't know how every company is going to move those levers to be more competitive or less competitive in the future. With a whole life policy, you don't care about all the moving parts. You care about money in, money out. To me, it's very simple. Build the policy. How much am I putting in at year 5, at year 3, at 5, at 7, at 10, at 20, how much cash do I have? What's the upside? What's the downside? Can I live with the downside? Is the worst case scenario, like who has the best worst case scenario? And that's what I go with, right? Like the upside is just a projection, even in a whole life policy. The current rate, so in an IUL, it's an illustrated rate and a guaranteed rate. And what would the performance of this policy be? And the guaranteed rate is saying, okay, if worst case scenario happened, what would happen? A whole life policy almost 100% of the time is going to beat the guaranteed rate, almost 100% of the time. On the current rate, a whole life policy, in my opinion, right now, because you're talking about companies with dividends between 6 and 7%, like if I don't see them going much lower. I mean, in the worst case scenario, that's not a big spread. So, the way I see it is it's going to be somewhere in between typically as far as the performance of a whole life contract, but it's always going to be can't say always technically, but the odds of it beating the guaranteed rate are like almost 100%, right? And so that is what it is. Same client, same amount of money, okay, so he's just going on and on. IRR, he's talking about running internal rate of return reports right here. And if you ran internal rate of return, tongue twisted, internal rate of return reports, you're going to see the IUL returns are always better than a whole life policy, quite a bit more, blah, 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 blah. Okay, yeah, that's great. But once again, I don't care about an illustration. I don't, because you can't illustrate the reality. The only guarantee in an illustration in an IUL is it's not going to perform like you showed it, right? It's most of the time going to be less. And here, let me get on my soapbox a little second here. So I want to make sure there's no other comments before how to overfund a whole life policy, keeping the death benefit as low as possible. I will do that in a second. All right. So here's what I'll say. IULs, think about it this way. Well, man, I should never read comments in between. I lost my train of thought. But here's what's going through my mind with an IUL right now, is that with your IUL, you are in a situation where the company is in complete control of the results. You don't understand, you have no control of the variables, right? In a whole life policy, you know what the variables are going to be and you can plan for them, right? So that's just something to kind of take into consideration. And I lost my train of thought, but I will get back to that. What is the best, hey Clark, what's up, man? What is the best insurance company to sell for? Man, so that's hard. There's not one company that does all right things for all people. I like Guardian for certain people. I like Lafayette Life for some people. Mass Mutual has some good policies. One America has some good policies. I would stay clear of the New York Lifes a lot of times, the Northwestern Mutuals. I would steer clear. Ohio National right now is going, they're talking about demutualizing, which is really, really bad. So I would definitely not buy an Ohio National policy right now. That's something. What are typical commissions on the policies that you design? So, Barb, I talked about this earlier. Policy design really depends on the objectives of the person. One of the things with whole life, it's always a give and take. I can do policy structures. First of all, I can't sell anything. I'm not licensed to sell. I'm just here giving education about this stuff. I can't sell you anything. So when I say policy designs and commissions, it's not me. It would be somebody else making those commissions, first of all. But to that accord, policy design is all over the map. I would say the bare minimum, what you would want to do is like a 50-50. What I mean by that is 50% base amount of insurance going all the way up to 50% paid up additions. What happens is you're going to have less liquidity at the very beginning of the policy, and you're going to have more liquidity as time goes on. Over a longer period of time, or like say a 20-year period, you're going to have as good, if not better, internal rate of return of a 50-50 policy because of the long-term expense ratios of the insurance and all that stuff. Inside of like a 60-40 plan or a 70-30, or you can even go 90-10 where it's 90% paid up additions and only 10% insurance. A lot of people would look at that as optimal. In a bubble, 90-10 sounds perfect all the time. That's typically the best that people can do. The problem with a 90-10 policy is that in order to do that, you have to use riders like term insurance riders, which make it so you have to have more insurance. So there's a charge there. But on top of that, if you're somebody who wants to utilize this strategy consistently going forward and you just want to get started with that, what happens is you have to get so much insurance that 5 years, 6 years from now or something, if you wanted to get more of it and start saving more, you're not going to be able to, because you're going to be capped out at the amount of insurance that you have. And at the end of the day, it's an insurance product. So a company has to be willing to give you life insurance. And if you're already tapped out as far as the amount of life insurance you can have, they're not going to give you any more. So that's the downside to a 90-10. I find typically anywhere between 90-10 and 60-40 is where the range is. So how much is the commission? It just depends on the contract the insurance agent has with the agent, with the carrier, and you go from there. That is that. Robert Clark, explain. Sorry guys, I'm just trying to go in order of the questions here. Explain how to overfund a whole life policy. How to overfund a whole life policy, keeping the death benefit as low as possible. Well, I just kind of actually talked about that a little bit. What I would do, Robert, is I would look at so there's the MEC limit. So MEC is modified endowment contract. When you MEC a life insurance policy, basically what you do is you turn that into kind of like an annuity in a way, where you have the growth of the policy goes in post-tax dollars, but you actually get taxed on the gains, right? So that can be negative. You want to always avoid, well, typically there are strategies actually that MECs work really, really well, but for most people, you want to avoid MECing the contract. Up to that point where it becomes a MEC, then you can, you get all the tax advantages. So what you want to do is you just want to start by saying, okay, here's the amount of money that I have, right? And that money, like let's say you want to put $1,000 a month into a policy, and you say, or let's just for round numbers say $10,000 a year. I want to put $10,000 a year into a policy. You don't go into it saying what is the insurance look like. You basically say, here's how much money I want to put into this, and here's the structure I want. Like, you have to be clear on what is your objective with the policy. Do you need short-term liquidity? Is it more of a midterm or long-term play for you? Depends on what your objective is. If you want to have that short-term liquidity, I deal with a lot of real estate investors, and my wife runs a real estate team, does a lot of real estate investing with clients. So I consult with a lot of real estate investors. They have a real need for short-term liquidity, right? Because I get a lot of like people that are saying, hey, I want to dump in 150 or 200,000 or 300,000. That gets a little complicated, because if you dump in a huge lump sum at the beginning, which is great, and you can do that, and you can have a lot of liquidity of that money, and it's phenomenal. The problem is, on the back end of it, you need to be able to continue with a premium payment that will not MEC the contract, if that makes sense. So it's kind of a moving target. I would just say make sure that you go in and you're focusing on the number that you have, say $10,000 a year. I would say start in the 60-40, like 60% base, 40% 40% paid up additions, and then do a 70-30, an 80-20, and a 90-10, and see an optimal design with a $10,000 right up to the dollar amount for a modified endowment contract limit. Like if the modified endowment contract limit needs to be $10,001, right? You're paying $10,000. The MEC limit has to be $10,001, so you're getting right up to that contract level. That is the level that the government says, hey, listen, if you put any more in this, the benefits are far too great, so we're gonna limit your ability to put money into this thing up to that, at that limit, because if you do, the tax benefits and everything, all the benefits are way too good. We don't want to incentivize people, because if people were able to put more in, nobody would ever put money into qualified accounts or anything of that nature. They just do this. That's just the reality. So the government limits your ability to contribute to these things. That's why they do it this way. Hopefully that helps. Why don't you have your life insurance license anymore? Are you planning on renewing it? No, Christian, I'm not going to. I don't think so. I think about it every day. I could make a ton of money if I did. I battle that thought, honestly, on a regular basis, especially the more of these videos I do. But here's the bottom line for me. I run a business development company. I actually just joined a company, an independent marketing organization, and I'm working on launching the company right now. But it is a whole life company. They represent and they train agents, and they just hired me to become the CMO, Chief Marketing Officer. So I'm working with them. I've been in negotiations and talking with them for a while. So rather than me, because I've been making these videos and I've been doing this for years, I haven't had my license since 2016, I think. And so rather than me making content and having nothing to gain from it, which is what I've been doing for the past 5 years, which is kind of stupid. I get the opportunity cost loss there for me. My business, though, has been helping life insurance agents build their business. So that's how I kind of like justify the time and the energy for myself. But I've also helped people in the executive job search space. I've actually written a book in the executive job search space. I'll actually show you, it's kind of fun. So I wrote this book last year, and it's a great book. It's helped a lot of people, and I've got another company that does that. I own 3 different companies. Business development is kind of what I do. So do I know Andrew? Like Doug Andrew? I don't know Doug Andrew personally. If Doug Andrews says he knows me personally, he's lying. That's just a flat lie. But to get back to the point, I don't think I'm gonna get my license again. I'm really looking forward to becoming a CMO of this company and helping them and helping create content for the agents and for the field so they can be more successful. Because honestly, if I'm gonna be real about it, I don't enjoy the servicing of contracts. I don't enjoy all of that. I enjoy the implementation of myself. I enjoy the vision. I enjoy like the execution of like using it to get real estate and build businesses and so on and so forth. But I have total ADD. I don't have the ability to like meet with every client every single year and be diligent about that. So I'm honestly not the best advisor like that. I'm very much better at helping people understand the vision and what they need to execute, but I'm not a hand holder. That's just not my deal, right? And so I feel like this new opportunity for me to go in and be a CMO and to create the content, create the vision, create the support, create the tools for the agents to be able to be more successful and actually go out and serve people in a more powerful way. That's kind of my unique ability, and I'm looking forward to it. So yeah, that's that. You need some help with your homework. I wish I knew about that, man. Tiananmen Square. No, I got nothing for you there. I think I've heard of that, but I don't even know what it is. So, all right, let me see if I got one more. I'll try to go through a little of this. Let me see here. I'm gonna boom. Let's see here. Again, you're not being honest in my assessment. I don't know. I feel like I couldn't be any more honest with my assessment of all this. I feel like the problem is these IUL agents get into this and they don't understand what they're even doing. They don't want to look deeper, right? Like, think about it this way. If you're trying to sell IUL and you just buy the sales pitch that the carrier who created the product is giving you, well, you're taking their training, you drank the Kool-Aid, and you look at all the ways that they try to tell you how to sell it, and it looks great, it looks amazing. But then once you do it for 5, 6, 7, 8, 9 years and you realize that they never perform the way that they look like they're gonna perform, and you start questioning and doing the math and looking at the policies and looking at the way that the annual changes to the policies happen and the reduced cap rates and the increased charges and all these different things, and you're like, okay, whoa, like this isn't what I thought it was gonna be. You start looking at it from that perspective, like this guy, Victor, we went back and forth quite a bit, you'll see here, right? Again, my analysis is flawed. I haven't drank the Kool-Aid. Oh yeah, you can see I told him he drank the Kool-Aid. That was pretty fun. Nor do I have an emotional connection to an IUL. I provide appropriate for the client and circumstances. You are one-minded and that's it. Nah, I'm not one-minded. I've sold more Index Universal Life in my day probably than he ever has or ever will. That's fine. You need to be accurate with the info you're posting out there. Once again, I'm happy. That's why I'm doing these videos now live. Anybody that thinks I'm not being accurate with anything I said, I will come on these videos live once a week minimally and give people an opportunity to come at me, because and I guess that's a big reason. That's a big reason I'm doing this, quite frankly, is people are coming at me on these comments and I'm feeling like I'm not able to get my point across online, in a text version. So I really want to be able to communicate and have people, have people be able to engage with me, as much as possible and have those conversations about these topics. How does the new changes to 7702 impact the whole life policies, the changes made by Congress part of the third stimulus bill? Yeah, so that's kind of crazy. that the 7702. So I'm still looking into this, but here's what I know so far is that we're talking about it's like anything else in life, it's a give and take. Here's what happened, as I understand it, and I'm probably going to do another video on this as time goes on. So here's the thing. Insurance companies went and they said, listen, they went to the regulators and they said, listen, we need to be able to sell more life insurance, or less life insurance, and I want to make sure I don't say it backwards. Ultimately, what was happening is the cost of insurance was too high, and they were saying, we can't keep our guarantees at the rates that we're charging right now, right? Our 4% guarantee. So you need to work with us. And so what they're doing is they're saying, listen, okay, we're going to be able to allow you to basically sell twice as much, put twice as much cash in, maybe not twice as much, but more cash into the policy for the same amount of premium, or for dollar for dollar. So the cost of insurance is going to get cut and more cash is going to be able to go into the policy. The caveat to that is the guarantees are going to get reduced. So the challenge is, if you're going to be able to probably make contracts more cash efficient, the give and take to that is the fact that you're not going to have the guarantees. Like, they're probably going to reduce the guarantees from 4% in whole life to either 3.5% or 3%. I've even heard some companies talking about going down to 2.5%. So it's always going to be a give and take in anything like that. It's just something to consider, right? Like, I'm a big believer. I want the guarantees because if you're a person who believes that we're going down a path where the government's going to keep printing money, where the economy is unpredictable, that bond rates and inflation or interest rates are going to remain low, that's the thing. People need to realize the government's not keeping interest rates low for your benefit. They're keeping it low for their benefit, because we're $30 trillion in debt right now. What does that mean? That means the federal funds rate is at an all-time low because of the fact that for every percentage point the federal funds rate increases the rate, that means the government has to service our short-term debt. 70% of all of our government debt is short-term debt. That means every time it rolls over, we're going to have to pay on that, right? It's going to cost us more to service our debt. So for every 1%, you're looking at about $1 trillion or $100 billion a year extra just to service that debt. So like, actually it's more than that now that we're at 30 trillion. That was it. So you're like probably 150 billion a year in that ballpark. I'd have to run the numbers to be exact on that. 150 billion just to service a 1% increase. So if we go up to the long-term trending average of the federal funds rate being around 5 to 5.5%, if we get to 5%, that's $750 billion just to service the debt. Just to service the debt without paying down the principal. That's just the interest expense on our debt. People are freaking out about the fact that we're spending $750 billion a year on our military. This is just going to be wasted money that we might as well just light on fire. So if you believe that that's a challenge and we're going to keep our interest rates low, that the entitlement system is going to be changing because it's broken, and like all these different things are in play, well, then there's more stresses on insurance companies and general accounts or whatever. So for me, I'm locking in the guarantees, because any contract, the 7702 for me is a way to say, listen, if I were an insurance agent and licensed right now, I would be selling the crap out of this. Why? Because I believe in the guarantees of whole life insurance. I believe in life insurance companies as being companies that are dynamic, ingenuitive. They hire the smartest people. They've weathered the worst financial storms in our history. I mean, most of these insurance companies have been paying a dividend every year without missing it since the 1850s, right? A lot of these companies. That means they got through the Civil War. They got through the Great Depression. They got through the 40s. They got through 1974. They got through, the dot-com bubble. They got through 2008. All these different things. They never missed a dividend payment. Where all these banks, all these other financial institutions, investment firms have all failed. Financial life insurance companies have always been there to weather. They know what they're doing. They're weathering that storm. They're not using fractional reserve banking. They're the more conservative way to go, right? So like, if I'm you, I'm going out saying, and I'm an agent, I'm going to take advantage of those guarantees, and I'm going to sell them, and I'm going to get the people I love locked into those guarantees, because it's going to be amazing as soon as you can. Now, that also, I'm just going to take that and pivot it and apply it to an IUL. All these IUL contracts that are being sold right now, all these insurance companies are concerned about being able to meet their guarantees. That's why the 7702 exists. So what does that mean? It means as the 7702 gets implemented, because of insurance companies having stress and being able to meet their guarantees, what are they going to have to do? They're going to have to find other sources of revenue to meet those guarantees. IULs are the easiest products in the world for them to tap into, reduce cap rates, increase charges, all that to create more revenue. Hope that makes sense. Which insurance company offers best whole life insurance policy? So that's a tough one. I'm not sure what you second, Christian, but awesome if you're seconding something I said. Thank you. Or maybe you are seconding something he said. I don't know. But which insurance company, in my opinion, offers the best whole life policy? Honestly, for me, that's a tough one because it just depends on who you are, what your needs are. Every company, there's not one company that just does all things for all people, honestly. It depends because remember, it's insurance. But if you're a healthy person and you're really insurable, I would say dollar for dollar right now as far as returns, company size, financial standing, ratings, reserves, all that stuff. I think Lafayette Life is a great company. The cost of insurance is low. The dividend, the performance of the accounts, the ratings, it's all good. I know that that's one of the reasons the company that I'm becoming the CMO with, that we're working on trying to work with Lafayette. I'll say that openly. I don't care. Another company, obviously, then you get companies like Guardian. Guardian's a great company. Mass Mutual is a great company. There are some restrictions and problems that Guardian and Mass Mutual have because they're New York regulated companies, and there become challenges in that sometimes. But at the end of the day, Guardian also has more reserves than any other company in the world. And if you have high net worth people, Guardian can be a phenomenal company. I will say Guardian also has a great app when it comes to managing your policy loans and your policy itself, being able to request loans, pay back loans, all this different stuff. It's very fluid. It's fantastic. So that is that. And let's see here. Any other questions? Let's go. Otherwise, I'm gonna probably go through one or two more questions. Then I'm gonna call it an afternoon on this end. I appreciate everybody being here because it's a lot of fun for me. But let's get into this a little more here. Okay, this guy Victor, he just kept saying the same thing over and over again. Same thing applies to whole life. Dividends dropping and other things can change. Yes, we already talked about dividends can drop, dividends can change. But once again, what's the upside? What's the downside? Can I live with the downside? The downside in a whole life policy is there are guarantees. Yes, the dividends can change. It may not be, the performance in a whole life illustration may not be as good as the current illustration. Sorry, my kids are coming home here. My wife just got home with my kids, and my office is right near the front door of the house. But dividends may be lower than the current rate, but they're never going to be as low as the guaranteed rate. I mean, maybe they will be, but once again, it'll always be a better performance than the guaranteed rate because at least year one, you're going to outperform that guaranteed rate, right? So that's a good thing. And he just keeps going on about that. So I'm going to get past him. He just drives me nuts. He just kept saying the same thing over and over and over again. Let's see if I can get to somebody else. See how many comments this guy gives me? It's nice to see he's so passionate about it, though. That's a good thing. Let's see what he said at first. So here this is a different video. He defended Doug Andrew. So this video is flawed on so many levels. First of all, you believe that everything written in that complaint is gospel truth. Okay, so basically he's talking about my video with Doug Andrew, and he's basically saying there's one complaint in there that was a guy who was sold a policy. The policy was horrible. The guy had $60,000 a year of income from his pension and his qualified accounts, and they sold him a policy that was over $60,000 a year of premium. It ended up financially bankrupting this guy. It was horrible, and therefore they got sued. It was a California guy Doug Andrews' son, Aaron, sold the policy. Doug Andrews' son, Aaron, was not even licensed in California. Minnesota Life wrote the policy. They didn't even catch it. It was just a complete nightmare. That was one thing. So that's the only thing I can understand that he would be saying that to, because the other things that I talked about with Doug are class action suits. Suits like 66,000 people suing Doug about, here, I'm gonna put myself here. 66,000 people suing Doug, literally, about policies not performing. 66,000, or not 66,000, but out of those 66,000, over 20,000 policies completely failed or were canceled because they just didn't work, right? That's insanity to me. So that's not an accident. Like, that's not just like, ooh, somebody made a little complaint. That's a catastrophe. That's a massive policy design flaw and a strategy flaw, or worse, it's not a flaw. He probably didn't design, because even a poorly structured IUL shouldn't have that bad. That means it's big misplacement, big misuse of funds, overly creating these policies that are not efficient, right? So they're eating the cash alive inside of the policy to fund the policies. And then the other one was they literally lost their license for selling unregistered securities that wound up being a Ponzi scheme as a vehicle for people to fund their policies. So, like, why did I do that video? The fact that people are giving me a hard time about making that video is mind-blowing to me, because all you have to do is Google search and you find all this stuff on Doug Andrew. That video is my kind of service to the industry to help people who are thinking about working with that criminal, keeping them from becoming a victim of his and his laser fund. His laser fund book and the whole program that he has going on is the same exact stuff as his Missed Fortune book that he made millions of dollars on, sold thousands and thousands of policies on, but then that's what wound up leading him to the class action suit. And if you look at the laser fund, you look at all the marketing, all the catchphrases, all the words, all this stuff, it's all the same stuff as Missed Fortune. It's just a different way to position the same exact thing, to a different set of people. And now that over a decade has gone by, he's hoping people have forgot about it. You go look online, it's the same thing. Doug Andrews lost his license over that. I gave up my license. You go look me up right now. I don't care. Go look me up online. I've never had a complaint, never had anything, had a lot of success, got Rookie of the Year, was a manager, head of business development for a Fortune 1000, like all that. I don't care. Look me up. That's fine. Go look Doug up. Tell me what you find. It's disgusting. So, anyway, do I know any companies that start new agents at 80%? No, I do not. Well, it depends on what you're looking for. Okay, I'm going. Wow, I just got a lot of questions here, so I gotta start at the top so I don't lose track of where I am here. Okay, where was I? Which insurance company? Okay, I did that one. Which whole life company offers insurance for foreign nationals? Ooh, that's a good one. That is, you know what? It depends on where you live. Is it Pan American Insurance Company? It's actually, Lafayette Life, I think, got bought out by a company, merged with a company that does that, but I don't know. I can't speak to that, but I can look that up for you. If you send an email to Chris@Life180, I'll reach out to a couple contacts and find that out for you, because I know there are some out there, and you have to tell me where you live to see if I can hook you up with somebody there. Cole, hey, thanks, brother. Good to see you. Patrick, thanks, man. Robert Smith, what do you think of the concept of become your own banker? I mean, I think it's no different than infinite banking concept. It's the same. It's all just different catchphrases to the same concept. It's utilizing properly structured whole life insurance to build an asset for yourself. It's how you leverage it. Like, that's the problem that I have with it. Like, there's not going to be a financial product in the world, as much as I love a properly structured whole life insurance policy, there's not going to be a financial product in the world that solves your problems, period. It's got to be part of a strategy. It's how you utilize that tool as leverage to accomplish what you're looking to accomplish. And I don't think any whole life policy or any insurance policy is going to solve, I don't think any financial vehicle at all is going to solve your problems. It's like, what is your financial system? What are your skills? What are your weaknesses? And how do you create a system to accomplish where you want to go? And I think the one that checks most of the boxes for me is a whole life insurance policy when structured properly. And that's why I like it. But the become your own banker thing is no different than IBC. It's the same thing. Oh yeah, and Christian just acknowledge that. Any company starting new agents at 80%. So what I would say, Patrick, is depends on what you're doing. If you're gonna go whole life, The answer is no. You know what, Patrick? It depends. If you're brand new, then the answer is no. But I know you can get there really fast. You know, I would avoid the career contract route. You could get an 80% contract easy if you're new with an IUL contract, but not with a whole life contract. That's the other thing about IULs, and this is my biggest belief. People are huge into IULs, and it's such a popular vehicle. Why? Because there's more money in it. So think about this logically, and I'm going to end with this, and then I'm going to go, and I'll do this another time. If anybody wants me to do more of these, just make comments and tell me to do more of them. I'll do these every day. I don't care. I really enjoy doing this. But here's the deal. People doing Index Universal Life, think about it this way. There's more. If I wanted to go out right now, I haven't produced in 5 years, right? For me to go out and get an IUL contract, I could literally go get a 140% direct contract because of the contacts I have. Granted, not everybody could do that, but a brand new agent, you call me up if you want to get a 100-point contract as a brand new agent, complete rookie off the street with an IUL. I could get you a 100-point contract right now, calling one of my contacts, and I could get in touch with my buddy Ryan, who could hook you up, and you'd have a 100-point contract overnight. Do you believe in what Caleb? Hey, Robert, do I believe in it? Yeah, I mean, I helped him create it, so I hope I believe in it. I help Caleb with a lot of his marketing. He's one of my clients, and Caleb's like my little brother. I mean, so just full transparency, the new organization, if you've been on this long enough, you heard me say I became a CMO of a company. Caleb and I are creating actually a certification course for the And Asset, because it's basically infinite banking with more clarity and a better story and more honest math, in my opinion. And so, do I believe in it? Yeah, I believe in it so much that when they asked me to be the CMO of this new company, I said the only way I would do it is if we got Caleb involved and we created a certification program and actually trained agents how to go out there and serve people in a pure way and do it the right way. Hey, Christian, if Oregon Cashflow Pro has convincing videos on IUL, email me links, chris@life180 to the videos, and I will do a review of them. I'll respond to them. I don't care. I love this stuff. Anything I can do to do all that, I'm good to do it. But getting back to that, like, I believe emphatically in Caleb. I mean, and you're not going to meet anybody in the world who's got a better. Caleb reached out to me before he really even launched BetterWealth the way in its current iteration and asked me to mentor him, and it was right after I gave up my licenses. It was before he wrote his book, and he came down. I actually said, hey, if you want to learn, come down to Arizona, I'll work with you. He came. He actually lived with me for a week. Him and Dan came down here. I started mentoring him and working with him, and he's grown it into some awesome stuff. And he's got an amazing heart. He's truly about serving people. He's truly about just telling a right message and coaching people through the process and doing the right math, and learning how. The cert for the And Asset is going to be a total game changer. I'm super excited about that. Actually, tonight, in about an hour and a half, I'm meeting with Caleb to go through the certification program. We got like 4 hours blocked off to go through, figure that out, because we're doing a launch on April 26th or 27th or something like that for the new company. So it's not even fully out there yet, and this is the first time I've even mentioned it on the air. But I'm super excited about it because I know there's a big lack of support for people doing the whole life thing. Tons of support in the IUL space because there's a lot more money in it. But think about it this way. This is what I was going at before, and I'm gonna end with this. If you were an insurance company, tell me how much sense this makes. Tell me how much sense this makes. You're gonna give more upside. You're gonna give downside protection. You're gonna have cheaper insurance. I'm thinking about all the things that IUL agents say they have. Cheaper insurance. And by the way, they're not going to tell you this, but the insurance company is going to pay them up to 50% more than they'd pay their agents for a whole life policy. So you're going to get more upside, downside protection, cheaper insurance, and the insurance agent's going to get paid more. How do you think that's possible? Does that make any sense? Like, think about it logically. It's not possible. It's a shell game. Like, they're just moving things around. It doesn't make any sense. How long does it take for a new agent to get to 80% with whole life? Not long. I don't know. Patrick, just reach out to me. I'll connect you with a guy that can answer all those questions for you. I don't know the answer to that, honestly, but I don't think it's very long. Email chris@life180.com and I'll help you out. I'll connect you with the right guy. You can have a conversation with him, and we'll go from there. So, all right, guys, any other questions? Otherwise, I'm going to bounce. I'll give it 30 seconds. I'll see, because I know there's a little bit of a lag where I'm talking and the comments that come through. And I got to go to a drink. I've been talking for an hour, and I forgot to bring water in here. So, is what it is. Any other questions? Well, I tell you what, if I don't see any other questions in there in the next second, I guess I'll end with this. I hope this helped. I know that this topic is confusing. Cool, man. I know the topic is confusing. There's a lot of moving parts. I know there's a lot of information out there about IUL. One of the reasons I've been on this kick lately is because I'm just on a mission. I'm calling it my rescue mission because, especially with the WFG and the PHPs of the world and all that, IUL is borderline on its own. When you get into the world of IUL structured in the way that the people inside of WFG and PHP are structuring it, it's dangerous. I just had one of the agents come to me. Her upline literally got her into a policy. She wanted minimum death benefit, maximum cash value, but she didn't know what she was doing, so she trusted the upline. And the upline basically sold her this policy. 2 years later, there's no cash value in the policy. It's not optimized. I looked at the illustration. I'm like, what the heck is this? It was not designed. So it was so bad. Luckily, she called Nationwide, and Nationwide gave her a refund, right? After 2 years, which is amazing for Nationwide to do. But the problem was she'd also done a lot of her friends, got her friends the same policy design. And guess what? Nationwide, once they realized, oh my gosh, there's a lot of people that are in this boat with WFG, they said, no, we're not going to do that. Why? Because they're not going to give the refund, because then to all those people, because it acknowledges that there's a problem. And if they acknowledge there's a problem at that level, it becomes class action worthy, right? So that becomes a problem. This is what's happening inside of these companies like WFG and PHP. There's no quality control. There's no education. People are expected to go out there and sell and recruit before they even understand. So they're like this lady that I've been working with and kind of coaching a little bit. They end up getting stuck in these positions where their reputation and everything is on the line. It's disgusting. Lafayette is based out of Cincinnati. I know you'd think it was based on, out of Lafayette, Louisiana, but it's not. It's out of Cincinnati. Is putting 20% of my net worth in whole life insurance for IBC smart? I would say, do you know people who put more than 20% of their net worth in whole life policies? Yeah, me, I do. So, I know many people that do more than 20%. I'm not going to tell you if it's smart or not. I think it's dependent on who you are and what your financial structure and strategy in your life is, how conservative you are, how much you want to leverage that money, what your plans are. So that's what I would say to that. So, hey man, all right, I'm going to go from there. I'm going to take off now, guys. I appreciate all of you. God bless. You guys have an amazing, blessed, inspirational day, and I look forward to seeing you. If you have any questions, any videos, anything you want me to check out, leave it in the comments below. I will check them. I get every comment. As you can tell, I try to respond to everything, and I look forward to seeing you on the next video. All right, have a blessed, inspirational day. We'll see you then. Later.